Are you comfortable sharing your banking data with other companies and startups? For us consumers, open banking comes down to this. So, what is open banking? How does it work? Is it safe? Is it worth a try? Hi, this is Sam Ghosh, and today we are going to talk about open banking. Open banking is a practice where banks are required to provide access to consumer data to non-affiliated third parties consented by the customers. So let's unbundle that. Banks provided access to consumer data to other organizations for a long time. But open banking mandates that customers are the owners of the banking data and the banks are mere custodians. The customers are the true owners of the data, and the banks are required to share data with organizations who intend to add value to the lives of the customers and not for the benefit of the banks. Open banking is going to primarily end the monopoly of banks gained through the control over customer data. Open banking as a concept originated in the Europe with the Revised Payment System Directive or PSD2 in 2015. PSD2 introduced the concept of consented data sharing with third parties. In the following year, that is 2016, UK's Competition and Markets Authority CMA published a report on UK's retail banking market, which found that older, larger banks do not have to compete hard enough for customers' business, and smaller and newer banks find it difficult to grow and access the market. To tackle this, they proposed a number of remedies, including open banking. Open banking enables customers and SMEs to share their current account information securely with other third-party providers. Now, open banking is spreading around the world, either in the form of market-driven, such as in India, Japan, Singapore, South Korea, and the US, or regulation-driven, such as in Hong Kong, Australia, apart from EU. But how does open banking really work? The building blocks of open banking as a system are based on how is the data being shared, with whom is the data being shared, and for what purpose the data is being shared. So how, with whom, and for what purpose. Many applications and organizations retrieve banking data using unsecured methods such as screen scraping. Applications which collect data using screen scraping often require the consumers to share their banking credentials, and sharing of banking credentials is fundamentally dangerous. Another issue is such processes of data collection can expose sensitive data to entities not intended and authorized to get access. Open banking regulations seek to formalize the data sharing process by making banks share data through secured application programming interfaces or APIs. As banks open up data sharing through secured modes such as APIs, legit entities will not need to scrape screens. Now the second question is, with whom the data is being shared? Just because someone convinces the consumers to share their banking data with them doesn't mean it is a legit entity and should be trusted. Open banking regulations intend to build a trust framework for these entities, who are called third-party providers or TPPs. For example, in the UK, the organizations seeking data access need to register in a directory of whitelisted TPPs as per order from the CMA, that is the Competition and Markets Authority. These regulations create a framework on not only who can collect data, but what they can do with the data. And that leads to the third question: purpose of data collection. In the absence of a framework, data may be collected for one declared purpose and used for many different purposes without the knowledge of the consumer. Open banking regulations also look into the issue of consent protection frameworks. For example, the UK's open banking framework proposes to codify customer consent and attach that consent with the data. This process seeks to address for what purpose the data use consent is given and what happens to the data after the user terminates the service. The framework also seeks to address one-time versus continuous data consent. Enough of this mumbo jumbo. Yeah, but how does it benefit us, consumers? Let's talk about that. Think about Google if it were only collecting a lot of data but never used or shared the data with anyone. That is how the traditional financial service companies, especially banks, are. They have enormous amounts of data but rarely use that data for any tangible purpose. Dormant data with the financial service providers can be used to create novel applications for consumers enriching their financial lives, as automatic transfer of funds from one bank account to another to avoid overdraft, or a single window for home buying involving estate agents, solicitors, and mortgage brokers. A long-term benefit for consumers is that open banking ends the monopoly of the banks over the financial lives of the consumers. As banks control the financial data of the consumers, the switching cost of banking is really high. Giving consumers and businesses control over their data will help them access better rates on overdrafts, savings, credit cards, and mortgages. They can top up savings more easily, save money on foreign exchange, and consumers with thin files will be able to get access to credit. For example, recently, JP Morgan and other banks announced that they will factor in information from checking and savings accounts for credit check purposes. So, customers will be able to get access to credit cards using data from their checking and savings accounts. Now the big question is open banking safe? There are two aspects to it. Yes, as open banking creates formal channels for banking data sharing, the flow of data can be made more secure, can be better monitored, and the data recipients can be held accountable. But at the same time, open banking results in a bigger surface area for cyber attacks. As per an Akamai report, cyber attackers are increasingly targeting API endpoints. As per a Gartner report, by 2021, APIs will account for 90% of the attack surface. By 2022, according to Gartner, API abuses will become the most frequent attack vector. Open banking regulations address this with stricter norms. For example, strong customer authentication under PSD2 guidelines. Strong customer authentication or SCA requires authentication based on the use of two or more elements categorized as knowledge, something only the user knows, possession, something only the user possesses, and inherence, something the user is. Sharing banking data is not new, and before open banking, the data sharing was, and still is in some countries, happening in non-standardized forms without proper tracking and monitoring. Open banking is formalizing the processes and making the data recipients more accountable with registration requirements and consent protection frameworks. We really do not know what kind of security threats may emerge with open banking, but formalization of data sharing process is likely to make it easier to retaliate against security threats, as the source of threat can be tracked much more efficiently in a standardized system. With this is Sam Ghosh. Thank you very much for watching. Bye bye.